Good morning and welcome to the Killik & Co market update. Markets have been weaker and more volatile over the last week following the discovery of the new Omicron variant. The variant was first uncovered in southern Africa, but it has since been discovered in many other parts of the world, including the US and the UK. Here's a chart showing the S&P 500 index over the last 2 years in percentage terms. As you can see, the index was previously up by 50% over this 2-year time period, but it has since sold off and it's now up by about 46%. As yet, little is known about the new variant, but early comments from leading scientists suggest that the variant is highly contagious, but that the symptoms are less severe than the symptoms that we've seen for other variants. However, little is yet known, and it's definitely the case that the patients who have so far been discovered to have the new variant have all been relatively young, so the situation still remains relatively uncertain. The big question is whether or not our current set of vaccines will work against the new variant, and we hope to have an answer to that within the next couple of weeks. The situation is therefore still highly uncertain, and this has led to an increase in market volatility, as we can see by looking at the VIX index. The VIX index measures options on the S&P 500 index that are due to expire in the next 30 days, and therefore it's considered to give an indication of expected market volatility. Here's a chart showing the VIX over the last 2 years. As you can see, it rose to an incredibly high level in March 2020 when the first lockdown started. After that, it did decline quite sharply, but more recently it has spiked up again. And as you can see, it's currently above the level of 20, which is considered to be consistent with heightened volatility. And also this week, the latest FTSE 100 quarterly reshuffle has been announced. And this is always a good snapshot of companies that have done well and not so well over the last quarter. This quarter, we've got 2 companies joining the index and 2 companies leaving the index. The first company joining is Dechra Pharmaceuticals, which has been a big winner from lockdown. Dechra focuses on medicines for the veterinary market, and it also produces a number of specialist pet foods. Huge numbers of people have bought new pets during lockdown. For example, here in the UK, 50% of households now have a pet, and 3.2 million new households have bought a pet during lockdown. The other company joining the index is Electro Components, which is a distributor of electronics components and equipment. It had spent the few years prior to lockdown building out its online offering, and it was incredibly well placed to do well when lockdown started. The first company leaving the index is Johnson Matthey, which historically has been an expert in catalytic converters, which are clearly very important at the moment, but which will not be needed for electronic vehicles. Therefore, the company had been trying to move into production of its own batteries for electric vehicles, and markets had been quite excited about this. However, in the last month, the company has announced that it's had to abandon this ambition because it was too capital intensive. The shares sold off very heavily when that news was announced. The other company leaving the index is Darktrace, which is a cybersecurity company focusing on artificial intelligence. The shares listed this year on the stock exchange and initially did very well, but in November this year, the lock-in period for early-stage investors ended, and we saw a huge number of early-stage institutional investors selling their holding, and that caused the shares to plummet. And at the same time of this, we have seen a number of reports in the press saying that some investors are worried that the company is not spending enough on research and development. And finally, Didi, which is China's answer to Uber, has announced plans to delist from the New York Stock Exchange and relist on the Hong Kong Stock Exchange. And this is yet another example of Chinese regulators putting pressure on the Chinese technology sector. Didi only listed on the stock exchange this year, and just weeks after its listing, the Chinese regulator ordered it to stop taking on new customers because it wasn't happy with how the company was handling customer data. That caused the shares to plummet, and as you can see by this chart here, the shares have never recovered. The news about the company having to delist from New York and relist in Hong Kong has also impacted other Chinese companies that are listed in the US, one example being Alibaba. Here's a chart for Alibaba over the last 2 years. As you can see, the shares have lost more than half of their value since last year, which is when the Chinese regulator really started cracking down on these Chinese tech companies. So please do give us a call if you'd like to talk about Chinese companies in a bit more detail. Moving on to have a look at next week, we're expecting results out from Ashtead and from Costco. That's it from us. Enjoy the weekend, and we'll see you next Friday.